Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
Welcome back, ladies and gentlemen, to the Family Banking Show. We are your hosts, Derek, Rob, and John. Guys, how are you this week?
Good. How you guys?
Doing pretty good. I'm in a hat right now. It's the first time and probably only time I'll ever, be in a hat, but I got the absolute worst haircut. The only solution is either just buzz it all off or wear a hat for a couple days and let my hair, settle back in. So chose the
Looks
latter.
good. Looks good.
I don't know if you guys are experiencing snow this morning, but we have a fresh layer of snow on the ground. So,
Yep.
of course,
First.
the 2-year-old loves that. So she's eager for winter, and her mother and I are groaning over the fact of having to do all the shoveling and salting, and you know how it goes.
My
Mhm.
1-year-old, he saw the snow and he was just in his diaper, like nothing else, and is like banging on the door, wanting to wanting to just get out there. I'm like, oh,
That's great.
down.
Ready.
Mhm.
All right, guys. Well, this episode, we're talking about some of the mechanics of whole life insurance, but oddly enough, we're going to be actually focusing in on convertible term insurance and how it relates to infinite banking or family banking. So, John, why don't you just give us a quick definition? What is convertible term?
Convertible term is just like any other term life insurance, right? We have the whole life and we have the term life. The term is where you only get the only benefit you get is a death benefit for paying a likely much cheaper annual premium for the same amount of death benefit. So you don't get any cash value, you don't get any of the banking qualities, you don't get any of the protections. It gives you a level, most likely a level or fixed premium for a level or fixed death benefit. And the term part means it's within a specific amount of time. So it goes from 1 year, annual renewing term, all the way up to, I've never seen anything greater than a 30-year,
Right.
term. And then there are two different even types of term that we'll talk about. One is just maybe like the kind that you get an employer, where it's just maybe like a group term where you don't have to go through any medical underwriting. They don't really care if you're healthy or not. They'll be able to absorb the cost of premium and be able to still provide that death benefit should you pass away within the time period. And that's just kind of the standard cookie cutter term. And then there's what's called convertible term, where you go through a medical underwriting. They give you a health rating, and there's a little bit more involved to that.
Yeah, so guys, why would we want to prioritize convertible term over, say, maybe the group term that John, you were just describing?
Well,
What's
the
the
convertible
benefit?
term, typically, I guess, in the context of how we're talking about convertible term, it's you're getting it with the kind of the idea of the option of converting all of it, or a portion of it into permanent life insurance. And so it's a strategic move that you are in. One of the cool things about convertible term is that when you get underwritten, as John said, you are underwritten at that moment for that convertible term policy throughout the term of the policy. Let's say 10-year, 20-year, and 30-year, let's say. So within that term, you are now underwritten at that health rating so that you can convert portions of it or all of it. Let's say even if you did get sick in the future, you are locked in at that health rating. You still have to pay the cost of the whole life insurance at the age you're at, the attained age, but you can lock that insurability in. So that's a really amazing feature of convertible term, is locking in that future potential ability to utilize it, to convert it into whole life. And so that's why you would go with convertible term versus some standard, group term or something you see on TV, for $10 a month or something.
Sure. Yeah. So, Rob, what you were describing is being able to convert it, meaning, let's take, for example, somebody purchased a convertible term policy when they were 30 years old, and it was a 30-year length term policy. So at any point in that 30-year window, you likely have that ability to convert it. Meaning, let's say now this individual, 20 years later, they're age 50, and they realize, oh, I no longer will qualify for permanent insurance, but I have this term insurance that I can convert into permanent insurance without having to go through any more medical underwriting, no more paramedical exams, no more sharing of your medical records with the insurance company. That was done when they were 30. But now that they're 50, they could convert a portion or all of that term insurance into permanent life insurance, even though at that age, they may have had a health event that would disqualify them from permanent insurance if they were to apply again. So let's get into the numbers, I guess, a little bit here, guys. If somebody has, let's just say, $1 million of convertible term insurance, and they wanted to convert $250,000 or $250,000 into whole life insurance, how does that work?
Yeah, so converting, in this case, $1 million of a convertible term policy is the fun part. Like that's where we come in. That's where we're the experts in figuring out what exactly works for likely is an increase in cash flow for someone. So generally, someone gets convertible term because they don't have the cash flow to fund their entire economic life value, we'll say, in completely whole life insurance, right? So you get maybe a mix of both. And now, say you got a raise in your job, or you have some sort of increase in cash flow, we'll call it $10,000, right? Now you have the opportunity to convert with zero medical underwriting or financial underwriting a portion of that $1 million convertible term death benefit into a new whole life policy that we can design however we want and meet whatever goals that you're hoping for. So let's say the 10,000, say you want, 250K of that to be transferred or converted into a whole life policy. You'll still maintain the overall 1 million death benefit, but now 250 of it will be in a new whole life policy, and that 750K will be in the remaining convertible term. And a couple things will happen. One is that 750K convertible term will be slightly cheaper, like the cost of death benefit is going to be slightly less because you're not now paying for $1 million, you're paying for 750. And then for the whole life, whatever age that you can converted that is going to be what the pricing is based off of, right? So say you're 30, like you're talking about, Derek, and you turn 35 and you're ready to convert a chunk into a whole life policy. You'll lock in the health rating you got at age 30, and you will then have what's called an attained age for your new whole life policy. So say you got the best health rating, but now it's just advance the clock 5 years, and that's what the premiums will be based off of for whatever death benefit you're transferring or converting.
And you could add to that policy too, right, John? I mean, we were talking about, is there a potential for adding a paid up additions rider component to that new converted policy?
Yeah, absolutely.
Tell us a little bit about the flexibility that we as agents have that we can help our clients with.
Yeah, so these new policies that are created or out of a convertible term have zero financial underwriting, and I think that's just a hack, honestly. It's like you can bypass some of the otherwise potentially strict guidelines and the underwriting, say you make $1 million and you're like, I want to put 80% of my income into whole life, and become my own banker and utilize this for tons of opportunities and just live off the 20%, which most people can very comfortably do, live off 200K. 80% of your income in a normal application cannot go into an annual premium. But in a convertible term, there's no financial underwriting. So you can actually put in more than whatever the financial underwriting, and generally it's around 25 to 30% of your gross income that can be approved for annual premium. But you can go far beyond that if that's what is right for your family, if that works for your cash flow. You can put in far more, and you can even have a lot of that be a cash value component, like we talked about, this PUA rider, and jumpstart the policy itself and having a better structure to it, totally without any sort of underwriting. It's just totally within our control, and whatever goals, like I was saying, you want to meet. We got to make sure it's not a modified endowment contract and it's not going to be negatively taxed. But as long as we're within those confines, it's really up to us and our creativity of how we want to design it, which is the fun part, kind of the nerdy part for us.
Yes. So guys, there's different periods of time that we can select as a convertible term policy. Let's just assume, 5, 10, 15, 20, 25 year, up to a 30-year term policy. How would you advise clients on which length of term to utilize? Is there maybe like a threshold or just a general principle that you guys have used in your practice, and what you would recommend as a length of term for that convertible policy?
Yep. Yeah, actually that segues nicely into a point I was going to bring up, Derek, is convertible term term in general is very inexpensive relative to permanent in the term that it's in. But if you see an illustration of a term policy, as we do, they illustrate it out to 100 or 121. So it might be $550 a year for that term period. But as soon as that term period expires, it starts going up rapidly. And so, especially right around age 65, that's kind of the rule of thumb, where you start to see that the actuarial tables, the insurance industry has been utilizing for the last 200 years, human lifespan, health, they have it all figured out. So they know that right around age 65, that's when the likelihood of someone passing away is starting to exponentially get higher. And so the cost of the term insurance starts to exponentially get higher starting around that age frame. So typically with a client of mine, we'll try to get as much convertible term as we can up to that 65-year-old range, because that's where it's cheapest, at least expensive. And so that's typically what I always go for is, if they're 45, we'll do a 20-year term. If they're 55, we'll do a 10-year term. It typically is kind of the rule of thumb. But I was just looking at a policy here, a term policy. It's $550 a year for $1 million a term for 20 years. And then on year 21, it's $7,050 for 1 year. And then and that's the tragic part that people don't think about, is right when you need the death benefit the most, if all you're banking on is term, right when you need it the most, it becomes the most expensive and unaffordable. Where if you just had the foresight to just pay that lower permanent death benefit, once you sign that contract, the insurance company is obligated to pay your death benefit, to your beneficiaries. They're obligated to pay them, and you get locked in at this rate that stays the same throughout the length of the contract. Where if you go term, right at that age when you need it the most, 65 or so, or whatever it might be, you can't afford to keep it going, so you drop it. And that's the big tragedy. So that would be, I'd say, the negative. The good thing about term is it protects you and that it gives you that extra death benefit that you need. It's a wonderful tool to have in conjunction with a permanent life policy, because typically with an infinite banking style policy that we design, it's lower death benefit, higher cash value so that you can utilize it for banking. But then often that doesn't cover you in the death benefit portion to protect your family at that moment, because you can't afford the premiums to get that amount of permanent death benefit. So a perfect way to do it is you supplement it, the whole life policy, with the convertible term policy to get the cash value, the banking ability, plus the protection for your family. And then you start converting pieces of it over time to more permanent death benefit, and just utilize, both of those tools to maximize the protection, the cash value, and the efficiency of the infinite banking process. So yeah, it's really, for all of our listeners who don't know, when that term period expires, if you want to keep paying for it, it will be way more expensive. And if you added up all the premiums, it's multiples more expensive than permanent death benefit. So it's really, permanent death benefit is a great value.
Yes, that's a good point to drive home. The true cheapest cost of life insurance over a person's entire lifetime is going to be purchasing whole life insurance.
Not even close.
And that speaks,
Guys,
I was going to say that speaks also to why universal life policies don't really work, especially for our context and application. As soon as you're maybe ready to take retirement income from your policy, or maybe you just don't want to fund anything additional into the policy, which for whole life, you can choose to do that. Maybe have the dividend pay for it, maybe make it reduce paid up, do tons of things in the whole life policy. But then for universal, it's just annually renewing term with a side cash fund, basically, in whatever index or variable or whatever it may be. And that annual renewing term looks super cheap when you're 25, 30.
Yep.
I'll never forget hearing someone talk about a seminar they went to where someone was pitching, IULs, and they said, you put in $20 a month, you'll have $14 million by age 65. And that's just not at all like even close to where it is going to be. And then also, not to mention, by the time you're 65, 70, that cost of insurance really starts to spike up, and
Huge.
most times kind of imploding or lapsing for that reason. So that, I think that just speaks to the power of getting something that's locked in, like for life, fixed and level premium with an increasing death benefit. Like your premium doesn't increase, but your death benefit increases, your cash value increases. But I was just going to say also, when thinking about, 65, I think, is a helpful rule of thumb there, Rob, like you were talking about, and kind of planning it out to that. But it's really just whenever you think you'll have the added cash flow in your life. Most people plan on having greater income as they maybe get more skilled in their work, or, create other passive income means to multiply their cash flow, whatever it may be. I think most people, and what I've found is most people do, except one person who I know is just kind of looking to sell everything and become a missionary and kind of at that route, which is totally his, calling by God, but which is totally fine. But if you are expected to have an increase in income, depending on what that timeline looks like, you can plan out almost, to the dollar, what that will look like in a convertible term sense, and prepare yourself for those increases in cash flow, right? If you're not prepared for it, what's likely going to happen? You're likely going to spend it on whatever new toy or gadget or electric vehicle or whatever it may be that you are having that lifestyle inflation or Parkinson's law.
Yep.
So it's also a way to just discipline your own plan, your own structure to any increase in cash flow. I know I can first capture it in a new policy and have it be within 2 to 3 days, probably you have your new policy. So just, it can be 10 years and someone knows that they're going to have an increase in cash flow in 10 years, then great. But for others, it could take 30 years, so.
Yeah.
And another thing I'll just add to is like, we care about convertible term because we care about the families and the clients we get to work with, because that economic life value and technically like life insurance historically is just an income replacement, right? It's if the breadwinner were to pass away the next day, you want the family to receive his or her income for the rest of his working years and beyond, probably, which is his economic life value, so that you can make sure the family is short term protected and long term taken care of in the cash value in the banking sense. So that's why we want to maximize the economic life value, whether that be mostly term initially, some whole life, however it can best be structured, but know that over time you can convert into whole life and protect your family.
Yeah, as I consider my own financial situation here, I'm 30 this year. The likelihood of my income going up over my lifetime is pretty high, and it's likely that that income is going to increase more than just once or twice. And so having a 30-year term length to convert over multiple years rather than just say like a 5-year term policy or a 1-year term policy, I'm at least allowing for the potential for more income increases over my lifetime than just once or twice. So I think for individuals who are probably, I would say 40 years or younger, it makes a lot of sense to look at a 30-year policy. And then of course, as you get closer to age 65, you're going to probably look at a shorter term length. And it also just coincides nicely with, typical retirement age too. Not only is there the actuarial science to back it up, like Rob was talking about, but for most Americans, they're looking to retire at age 65 or 67, somewhere in that timeline. And so, the likelihood once somebody reaches retirement of them converting a term life insurance policy into a permanent life insurance policy it's not very common, but that scenario would play out really well for somebody who has guaranteed income or passive income coming in. So if that's not you, if you don't have those sources of income, then maybe just think about, okay, I want to convert this term policy probably before I reach that retirement age, because you don't have that steady, stable income coming in. All right, guys. Well, I think this has been a tremendous episode and helpful when thinking about convertible term. Is there any other comments that you guys would like to make for our audience here before we sign off?
Yeah, maybe just a couple final thoughts. When I talking to clients about convertible term, typically, it's usually based on their health and the age we're working with them. It's relatively so inexpensive. So if you could go 10, but it's so inexpensive to have that extra protection for your family that it just seems to always make sense to people that let's go to 20, because why not? It's you're locking in that rate for that period of time. If you're young and healthy, it's so cheap and gives you all that flexibility. I like to go 20 if it makes sense. Also, just a side note, some carriers, insurance companies, they have a limitation where they won't convert anything over 20 years. They'll go up to 20. So you can still be protected from 20 to 30 with a term policy, but you might not be able to convert it. So just a side note to make sure, talk to us when we're talking to our companies. We'll make sure we design the right one for you.
Yeah, and the last thing I was going to say is this certainly speaks to the think long term or long range, principle of infinite banking, and that Nelson Nash left us with. And another added reason, not only maybe you get better at your job and you just increase your income and have other passive income streams, whatever it may be, just due to the nature of inflation. I think we can all pretty much guarantee that inflation is going to happen over our lifetime. Therefore, our income is going to increase, and hopefully our income increases and outpaces the cost of living that we need to live on. But and so anything in excess there, I think, would be just super valuable to capture in these policies. So.
All right. Well, if our listeners are interested in working with us and designing a policy that meets their family needs and gives them the ability to become their own bankers, you can reach out to us at thefamilybankingshow@gmail.com and schedule a time to meet with us. Guys, thanks again for this episode, and we'll see you in the next one.
You guys.
thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.